Hello, welcome to the A Book a Day channel. Today, we're going to discuss the book Common Sense on Mutual Funds by John Bogle, a legendary figure in the American mutual fund industry. Among all investment books, Common Sense on Mutual Funds is likely the most relevant to ordinary investors. In this book, the author describes a simple, long-term investment strategy that anyone can learn. This method has been proven effective over the long term by over a century of data from the American market and offers returns far exceeding regular savings deposits. What is this magical method? Let me give you an analogy. Imagine you have a hobby of rolling snowballs. In winter, when it snows heavily, you find a long slope covered with wet snow. You start by making a small snowball with your hands and then slowly push it down the slope. As it rolls, it gathers more snow and grows larger. This process of rolling a snowball is akin to investing. When you invest in the stock of a good public company, like Kweichow Moutai, it's like entrusting this company to roll the snowball for you, growing your principal as it rolls. But how do you choose the companies with the best snowball rolling abilities? This selection process is highly specialized. Moreover, a company's ability to roll the snowball changes constantly. A company might be excellent one year and not so great the next. If you entrust a company, you need to constantly monitor and track it, which is too time-consuming and exhausting for most people. At this point, someone offers a very simple solution. Create a plan that helps you select a few hundred relatively reliable companies to roll the snowball for you. If some companies fall short along the way, they are periodically replaced with new ones. So, you just need to entrust the snowball rolling task to this plan, and you don't have to worry about anything else. Each company here represents a stock of a listed company, and the plan that selects hundreds of companies is called an index fund. For example, the S&P 500 index in the United States is composed of 500 companies, and the CSI 300 index in China is composed of 300 companies. When you buy an index fund, it's like simultaneously entrusting hundreds of listed companies to roll the snowball for you. Because this method seems effortless, requiring no active intervention after purchase, this long-term holding investment strategy of buying index funds is called passive investing. The author of this book, John Bogle, is the inventor of the world's first index fund. This tool provides an excellent investment method for ordinary investors. Throughout his life, he received numerous honors, even earning high praise from Warren Buffett. At the 2017 Berkshire Hathaway annual shareholders meeting, Buffett praised John Bogle greatly. Buffett said, "John Bogle has done more for American investors than anyone else." When Bogle first started offering index funds, almost no one on Wall Street wanted to help because index funds lowered investment fees and Wall Street's profits. Today, the returns brought by index funds to investors surpass almost any other financial product. This book is John Bogle's most classic work, specifically written for the public. It uses a large amount of convincing data and evidence to comprehensively explain Bogle's core investment philosophy. In the following time, I will break down the book into 3 parts for you. The first part will explain why passive investing has advantages and how to do it. The second part will discuss the qualities a qualified mutual fund investor should possess. The third part will cover how Bogle's investment philosophy can be integrated with the realities of your country. Let's start with the first part, why passive investing has advantages and how to do passive investing. Earlier, we used the analogy of rolling a snowball to briefly introduce passive investing. Now, let's delve into it a bit more. Broadly speaking, there are 2 ways to invest: active investing and passive investing. Active investing involves conducting your own research to pick a stock you believe is good and timing your buys and sells accordingly. Since this process requires making many decisions, it is called active investing. Warren Buffett is a representative figure of this approach. In contrast, passive investing neither involves selecting stocks nor timing the market. Instead, it employs the simplest method: buying a basket of stocks and holding them for several years, or even decades, without making any changes. Don't underestimate this seemingly simplistic approach. John Bogle, the author, tells us that by doing this, you can outperform most professional fund managers. So, what should you buy for passive investing? John Bogle recommends buying index funds. First, let's explain the concept of mutual funds as mentioned in the book title. In the United States, mutual funds refer to what are commonly known as public funds in China. These are funds that publicly raise money to invest in securities, futures, bonds, and other financial instruments. Public funds can be divided into many categories, with index funds being one of them. In the U.S., index funds already account for 1/3 of the total public funds. What does index and index funds mean? Stock market indices are usually calculated by a third-party institution using a simple mathematical method. For example, the Shanghai and Shenzhen 300 Index, CSI 300 in China, is a well-known index. It selects 300 stocks with good performance and large market value from over 3,000 stocks in the market and calculates a stock index through a weighted average. By observing the rise and fall of the CSI 300 Index, you can roughly gauge the performance of the entire A-share market on a given day. If you buy all 300 stocks in the CSI 300 Index in proportion to their weights, you essentially have an index fund. Since this investment method doesn't require stock selection and can be done with a single purchase, index funds have become the primary tool for passive investing. So, what are the benefits of using index funds for passive investing? John Bogle highlights several key benefits. Let's go through them one by one. First, high long-term returns. Historically, among all asset classes such as stocks, bonds, and gold, stocks have the highest long-term returns. In the U.S. over the past 200 years, the long-term annualized return on stocks has been around 7%. This return rate is twice that of bonds and significantly higher than gold. Long-term returns on gold are almost negligible. So, why do stocks have the highest investment returns? John Bogle further provides a formula for the sources of stock returns. He believes that in the long run, stock returns come from two components. The first is the dividend yield at the time of purchase. This number represents the company's ability to pay dividends. The higher it is, the stronger the dividend capacity. The second is the future earnings growth rate of the listed company you bought. We know that listed companies are typically the best quality companies in a country's economic system, and their average earnings growth rate is likely to exceed the overall economic growth rate of the country. Therefore, as long as a country's economy is on the rise, buying and holding listed companies can yield good returns in the long run. In addition to high long-term returns, John Bogle identifies two other significant advantages of passive investing: low costs and no need for market timing, meaning no need to choose the timing of buying and selling stocks. Regarding low costs, let's look at an example. Assume you have two investment options. Plan A is to buy an existing fund on the market, with 35% of its assets invested in U.S. bonds and 65% in U.S. S&P 500 stocks. Plan B involves still investing 35% in U.S. bonds and 65% in U.S. S&P 500 stocks. But instead of buying a single fund, you purchase a bond index fund and an S&P 500 index fund separately. The final investments are essentially the same, but the index funds are cheaper, with annual fees 0.9% lower. If you invested $10,000 in each plan in 1947, after 50 years, Plan A would grow your $10,000 to $1.08 million. Plan B, however, would grow it to $1.615 million, nearly 50% more than Plan A. Since the investments in both plans are the same, the significant difference in results is entirely due to the slight annual fee difference of 0.9%. This example illustrates that reducing costs is crucial in long-term investing. John Bogle even considers cost reduction as the primary factor in long-term investing, as any minor cost difference can be magnified over time. Having discussed the advantage of low costs, let's examine the third advantage of passive investing: the benefit of not timing the market. Not timing the market is easy to understand. Since index funds continuously hold stocks that match the index, they don't involve selling, thus eliminating timing issues. But does not timing the market constitute an advantage? Let's ask the reverse question: is timing the market an advantage or a disadvantage? The book cites examples of the timing abilities of the media, fund managers, and ordinary fund investors, revealing that most of the time, their timing results in negative returns. Therefore, not timing the market becomes an advantage. First, let's look at media timing with examples from two top American magazines. On August 13, 1979, Businessweek published a cover article titled "The Death of Equities." As the title suggests, it was pessimistic about stocks. However, when the article was published, the Dow Jones Index was at 840 points, nearly a bottom. By May 1983, the market had risen by nearly 50%. Another, even more astonishing story involves Time magazine. On September 26, 1988, it published a cover article titled "Buy Stocks. No Way," with a giant bear on the cover. When this article was published, the Dow Jones Index was around 2,000 points. After that, the index began to climb and eventually reached 9,000 points. Given that top magazines often misjudge, how can we trust smaller media outlets? Bogle concludes that media timing is often unreliable. What about professional fund managers? How is their timing ability? We can gauge fund managers' timing diligence using an objective statistic, turnover rate, which measures the frequency of buying and selling stocks within a specific period. A higher turnover rate indicates more frequent market timing attempts by fund managers. In the 1940s to 1960s, the average annual turnover rate for U.S. stock fund managers was 17%, meaning it took over 5 years to completely change the stock portfolio. By 1997, the turnover rate rose to 85%. Another decade later, in 2007, it reached 105%, meaning the entire portfolio was changed annually. Over several decades, U.S. fund managers have become increasingly active in market timing, with more frequent operations. But what about the results? Unfortunately, there is no evidence that the management level of U.S. stock funds improved with increased turnover. On the contrary, the increased costs from higher turnover rates have harmed fund performance. Finally, let's look at the market timing abilities of ordinary fund investors. Many retail investors try to time their fund purchases and redemptions, a trend observed in both China and the U.S. So, what do U.S. data tell us? From 1975 to the first quarter of 1981, U.S. investors continuously withdrew funds from public funds for 24 consecutive quarters, withdrawing about half of the initial capital. After such massive withdrawals, a new bull market began. The market began to warm in the third quarter of 1982 and peaked in 1987. In the first 9 months of 1987 alone, investors poured $28 billion into public funds, but unfortunately, the market crashed in October. This pattern is consistent in China, the world's second-largest economy. Ordinary fund investors' timing actions often result in negative returns. When funds are selling well and investors are rushing to buy, it is usually not a good time to invest. Conversely, when funds are hard to sell and investors are reluctant to spend money, it is often a good time to invest. Let's recap the first part we discussed today. This part mainly focuses on the advantages of passive investing and how to do it. The primary method of passive investing is to buy and hold index funds. The benefits are at least threefold. First, stocks offer the highest long-term returns. Second, index funds have much lower costs compared to other funds, which become a significant advantage over time. Third, passive investing does not involve market timing. Not timing the market is an advantage, because most timing attempts by media, fund managers, and ordinary investors result in losses. In fact, in the long run, index funds outperform most actively managed funds. Now, let's move on to the second part: what qualities a competent fund investor should have. In this book, John Bogle provides several rules and suggestions for fund investors, which I have summarized into the qualities of a competent fund investor. To be a qualified fund investor, you need to have at least 3 essential qualities. The first quality is not to blindly trust a fund's historical performance. If you conduct a small survey and ask people around you what their basis is for buying a fund, you'll likely get responses like, "This fund performed well last year," or "The fund manager is very famous." In fact, historical performance and the fame of the fund manager are the indicators that retail investors pay the most attention to when buying funds. These are also the points that fund sales agencies emphasize the most during the sales process. However, John Bogle explicitly states in this book, do not overestimate the importance of a fund's historical performance, and be especially wary of star fund managers. The book provides detailed research data. Funds were divided into 4 groups based on their performance in the 1970s. Then, their performance in the following decade, the 1980s, was examined. The results showed that the group of funds with the best performance in the 1970s had an average annual return 4.8 percentage points higher than the index, but in the 1980s, their performance was 1 percentage point below the benchmark, showing a clear mean reversion. In other words, the better the past performance, the worse the future performance. This pattern repeated in the period from the 1980s to the 1990s, and again in the 10 years from the 1990s to 2009. Since we can't rely on a fund's past performance, how should we select a fund? John Bogle believes that making decisions based solely on a fund's historical performance is unreliable. However, historical performance is not entirely useless. We should use it to evaluate the consistency and risk level of the fund manager. Consistency has two meanings. First, whether the fund manager's actions align with their stated strategy. If a fund manager claims to follow a value investment strategy but actually buys poorly performing stocks, that fund is untrustworthy. The second meaning of consistency is whether the investment style has remained stable over time. If the fund manager switches between buying large-cap stocks and small-cap stocks frequently, the fund's performance should be questioned. Regarding risk, we should look at the fund's historical volatility and whether the manager can control risk during market downturns. In summary, we shouldn't select a fund based on past performance alone, but we can use historical performance to filter out unreliable funds. The second quality of a competent fund investor is to understand the inverse relationship between asset size and performance. That is, the larger the asset size, the less likely the performance will be good. Asset size is an easily overlooked but very important factor. There is a saying in the fund industry: size is the enemy of performance. The larger the size, the harder it is to achieve returns that exceed the market. From time to time, extremely popular funds appear on the market, raising hundreds of billions of yuan at issuance. However, such funds often underperform. Therefore, be cautious with very large, popular funds. Additionally, John Bogle advises ordinary investors not to buy too many types of funds. Follow the one-hand rule, meaning buying within 5 funds is sufficient, and even 2 to 3 funds can be enough. The third quality of a fund investor is to have a long-term investment plan. Speaking of index funds, we can see that there are many stock indices in the market. For example, in China's A shares, there is the CSI 300 index representing large-cap blue chips, the CSI 500 index representing mid-cap companies, and the Chi Next index representing small-cap growth companies, among others. Different indices correspond to different index funds. So, does choosing different indices make a difference when investing? John Bogle's answer is that in the short term, there are differences, but in the long run, there is almost no difference. He studied 2 typical indices in the U.S. market: the S&P 500 index, which represents large stocks, and the Wilshire 5000 index, which represents small stocks. Although the performances of these 2 indices differ in the short term, 3 to 5 years, over the long term, 30 years, from 1970 onward, their total returns were the same, with both earning an annual return of 13.7%. Let's summarize the second part. We discussed the qualities of a competent fund investor. Particularly noteworthy is that you should not select funds based solely on past performance, as this method is unreliable. Instead, choose funds that align with your investment philosophy, have consistency, and have shown good risk control in the past. This book's first edition was published in 1999, and the version we are discussing is the 10th anniversary edition published in 2009. In this edition, the author added many updates from the 10 years following the first publication. Now, another 10 years have passed since this reprint, and many significant events have occurred regarding passive investing and index funds. In this third part, I will update you on these developments. Firstly, in the past decade, index funds have become increasingly popular and accessible to ordinary investors. Taking the United States as an example, the past decade has seen a boom in the growth of index funds. The scale of index funds has been rapidly increasing each year. By the end of 2017, the total assets of mutual funds in the U.S. reached $18.7 trillion, with index funds accounting for more than 1/3 of this total. Similarly, the index fund industry in other countries has also been experiencing rapid growth. By the end of 2018, the total assets in index funds exceeded $6 trillion, making it the fastest growing category of funds in recent years. All of this growth began with the creation of the first index fund by John Bogle, the author of this book, in 1975. Over the following decades, people discovered that index funds enabled ordinary investors to invest easily and share in the long-term economic growth of a country. Consequently, index funds have gained widespread acceptance. In fact, investing through index funds provides not only the three major advantages of passive investing that we discussed earlier, but also two additional significant benefits that Bogle did not mention in the book, but are worth noting. One additional advantage is that index funds do not rely on any star fund manager. The goal of an index fund is to achieve the same investment return as the stock index it tracks. Therefore, it does not require human intelligence to pick stocks or time the market. It simply needs to adjust periodically according to the changes in the index's constituent stocks. This reduces its dependence on individuals. Changing a fund manager midway has no impact on the performance of an index fund. If you are planning to invest for more than 10 years, this stability and lack of reliance on individuals is crucial. The second additional advantage is that the design philosophy of index funds inherently includes the investment principle of buying more of the best companies. The method of constructing stock indices is usually based on market capitalization weighting. This means that the larger a company's market capitalization, the higher its weight in the index. Correspondingly, when an index fund buys the constituent stocks, it buys more of the shares of the larger companies. For example, we previously mentioned the well-known CSI 300 index in China's A shares, which is composed of 300 constituent stocks weighted by their prices. Among these constituent stocks is the well-known Kweichow Moutai. At the beginning of 2009, Kweichow Moutai's market capitalization was about 120 billion RMB. By the beginning of 2019, its market capitalization had grown to 900 billion RMB, an increase of approximately 7.5 times. This means that, assuming the total market capitalization of the CSI 300 index remains unchanged, over these 10 years, as Moutai's market capitalization grew, the shares of Moutai held by the index fund also increased several times. This effect occurs because the method of constructing indices naturally incorporates the principle of survival of the fittest, allowing index funds to buy more shares of high-quality companies. As we mentioned earlier, in addition to the three benefits discussed in the book, index funds also offer two additional advantages. They do not rely on individuals, and they follow a natural survival of the fittest investment philosophy. Understanding these two additional advantages makes you more knowledgeable than most people. Conclusion. Finally, I want to share some personal reflections and suggestions about this book from a professional investor's perspective. This book discusses the advantages of passive investing. But does that mean everyone should invest in index funds? Let's review the theoretical foundations of passive and active investing. The theoretical foundation of passive investing is that the market is fully efficient. In simple terms, this means all information is already reflected in stock prices, so trying to outperform the market is futile, just following the market is good enough. The theoretical foundation of active investing is that the market is not fully efficient. There is always some information not yet reflected in stock prices, and uncovering this information can bring us excess returns. Therefore, by using our intelligence and efforts in stock picking and market timing, we have the opportunity to achieve returns higher than the market average. Based on this, we can create a coordinate system. The higher the market efficiency, the more we lean towards passive investing. The lower the market efficiency, the more we lean towards active investing. We know that the US stock market is likely the most efficient in the world. So the last 20 to 30 years have shown that index funds are increasingly favored by investors. Each country's stock market has its characteristics. In some countries, the stock market has had short bull markets and long bear markets over the years, and a long-term bull market trend has yet to form. If you were unfortunate enough to buy an A-share index fund at the peak in early 2008, you would still be at a loss 10 years later. Additionally, in some countries, retail investors still dominate the market, leading to high market inefficiency, which objectively provides many opportunities for active investing. In this book, John Bogle's common sense is very important. However, after considering the characteristics of different markets, I suggest that we think more deeply. For retail investors who lack the time, energy, and professional skills, there are two options. One is to invest in index funds, preferably through a fixed investment plan, where you invest a fixed amount of money each month to average out the cost and smooth out volatility. This option suits most people and is the one I most recommend. The other option is to buy actively managed funds that have been carefully selected. Because the inefficiency of some countries' stock markets does provide a stage for active investing. However, you need to know how to choose a fund and not just rely on past performance. This option is only suitable for a small number of people with the necessary skills. For professional investors, while certain countries' markets offer opportunities for active investment management at this stage, the rapid development of index funds is not an enemy of active investment management. On the contrary, index funds can be a great tool in many active management strategies. These are my personal thoughts and suggestions for your reference. Finally, let's return to the book's title, Common Sense on Mutual Funds. I am very fond of the saying, common sense is the most valuable. Thanks to John Bogle's invaluable insights, ordinary investors can invest easily through such a simple method.